Live from New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, failing to settle the transitory debate as higher prices start to weigh on confidence, Fed officials lining up a taper decision. We begin with the big issue, no resolution to the big debate.
Used car prices are starting to come down. The gasoline prices are starting to come down.
The supply issues are probably going to be transitory.
Some of the inflationary pressures are moderating.
If it's slowing down, then it's not ripping out of control.
It supports the Fed's transitory narrative view.
Looking through the other categories of the inflation print, there's plenty of 2% plus inflation pressure out there. It's across sectors.
Some of this will stick around.
I just don't think we're quite through this much higher than 2% inflation just yet.
My biggest fear is on the labor side.
Wage growth side is probably going to be a bit more persistent, especially in the US.
We're still getting the inflation that many people thought we would have to pass through.
Inflation will ultimately prove transitory.
I don't think inflation is all transitory.
Joining us now is Tony Rodriguez of Nuveen, Crossmark's Victoria Fernandez, and Jean Tannuzzo of Columbia Threadneedle. Victoria, I want to begin with you. Come straight over to you and ask you the question. Have we resolved anything with the data this week?
No, I actually think we've added more confusion and more uncertainty to what we were doing. I mean, yes, there are some transitory components, and we saw that in the CPI number, and some of the clips mentioned it. The car rentals have come down, hotel prices have come down, airfares have come down, but yet we still have this other component that we're not really thinking of. You look at owner equivalent rents, that's almost a third of CPI, and that's moving higher. You look at wages continue to move higher. We see that in the labor report, and I think it will continue to do so as we have this labor shortage for so many companies. That's going to be a little bit more permanent. That's not going to be a transitory effect. So are we going to go back to that 0 to 2% inflation? Probably not. I think we're going to be higher than that. Does it come down from where it is now? Yes, because you have that transitory component spikes that might come back a little bit. But I'm concerned. You know, Jonathan, the supply side is where I'm really looking. Everyone thought that was the transitory component. If the Delta variant pushes that timeline out longer, then the supply side is not so transitory, and we kick that can down the road. That's the big question. Is that a year, 18 months, 2 years? I'm not sure we know the answer to that.
That final point is so important. Jean Tannuzzo, your view on that?
Well, I think it's we have learned a bit this week. We have seen some deceleration in some of the most transitory factors. But I think the point raised is a good one, that not all of the factors of inflation are transitory. There are sticky factors, and those sticky factors relate a lot to the housing component. Owner's equivalent rent is likely to be well above 2% as we get to the end of the year and into next year, given not only what's gone on with house prices, but also with rents. I think that labor is, in fact, the wild card. And I think the season of kids going back to school and whether or not that is in person is absolutely critical. So the crossroads right now are pretty intense. I think to the extent that kids end up being more so home and virtual, if kids are home, parents are home, and that impacts the ability of individuals to re-enter the labor force, particularly in two-income households. And I think that could keep some of those inflationary pressures and wage pressures higher for longer.
Jean, that speaks to the supply side story that Victoria raised. And Tony, I want your view on this, because it's not just labor supply we need to watch. It's what's happening in China and whether we face the real risk here of a second wave flushing through the system. And the idea that somehow supply chains would heal as the year grew older, maybe we need to push that out, to Victoria's point, to Q1 next year, to Q2, I don't know, maybe even beyond.
Well, Jonathan, you raised a great point. And, you know, even beyond China, we're seeing it in Vietnam, we're seeing it in Indonesia. So the supply bottleneck issues are going to be with us longer than I think most people expected. What I do think we learned, though, this week is that inflation is moderating. It's certainly not transitory. If people thought it was going to be well behind us by the end of the year, we're going to have an elevated level of inflation through the first half of next year for sure, and potentially even into the second half. However, it will be moderating and lower than we are today. And I think the Fed will be pleased with the fact that it won't be heading back down to below 2%. So our view is that by the end of next year, you may see kind of core inflation levels back into a 2.25 to 2.5 range, as opposed to above 4% where we are today. So not transitory, but not problematic either for the markets, and moderating throughout the next 6 to 12 months.
Something in the middle. Let's talk about what's happening right here, right now. Reopening demand was clearly driving prices. Now we're starting to ask whether prices are starting to weigh on demand. We had consumer confidence, consumer sentiment out a number of hours ago, and it was the weakest since 2011. And this was the quote from the Michigan Consumer Sentiment Survey. Consumers have correctly reasoned that the economy's performance will be diminished over the next several months, but the extraordinary surge in negative economic assessments also reflects an emotional response, mainly from dashed hopes that the pandemic would soon end. Victoria, I want your view on this. Just the idea that demand was driving prices and now prices seems to be shaping demand.
Yeah, I think we're in a situation, at least, where the consumer, their household balance sheets are so strong that they can take a little bit of the price pressure that's going to come along with that. So maybe we don't see demand fall off tremendously at first. For goods, it will definitely come down. For services, though, I think it's going to continue to be there. We look at the confidence report today. It was the expectations component that really dropped. And I think some of that flows through to what Jean was mentioning earlier in regards to schools. If parents think that, wait a minute, my kid's not going to go back to school, that things are not going to get back to normal, then perhaps they do pull back a little bit. Perhaps they say, wait, unemployment insurance is going to be going away, or it already has in about half the states. So does that mean I have to save a little bit more? Does that pull demand back? It could, and that's going to affect the margins for earnings going forward, and that's key for the equity market.
So the conversation we've had through the first 5-6 minutes of this program is really the analysis, the framework for thinking about things at the moment as we look at some of these dynamics. Let's push this through the market. We've had a move from north of 170 at the end of Q1 all the way down to 112. We saw 112 last week on a 10-year yield. Today, we're at 130. Yields have come in about 5 or 6 basis points. All the things we're discussing, Jean, either they reinforce a Treasury move we've already seen, one that's behind us, or this is fuel for another leg lower in yields. Which one is it, Jean?
Well, I think what we're seeing today with the disappointment in consumer sentiment, that could fuel a little bit of a move lower in yields. And we could, in the short run, maybe retest the 112 or even closer to the 1% area. And I think it comes back to something that the Fed highlights in their statement, which is that the path of the virus will be a critical variable in determining the path of the economy. And it's a real question on how much are we changing consumption patterns right now in what we thought was a clear path to recovery. Now, on our side, our research team puts together something that we call our return to normal index, which is how close are we to 2019 levels of activity across various sectors of the economy. We were at about 86% 2 weeks ago. We've taken a little step back to about 83%. It's not a huge turnaround, but if that trend continues, I think that will definitely inform the path of yields and the path of Fed policy.
Tony, I want your view on that as well. The same question, how you'd push through the conversation of the last 8 minutes through the Treasury market.
Sure. So if you were to believe that the sentiment numbers today would lead to a significant drop in spending, then we would certainly have a lower yield environment coming up. But if you look at the sentiment numbers last summer, for example, they bottomed out, right at the pandemic, and they stayed in a 75 to 80 range throughout the second half, while spending itself actually rebounded very, very quickly over the summer. As vaccines became more prevalent, the economy opened up. So as with politicians, Jonathan, with consumers, watch what they do rather than what they say. So while we think that they're not going to remain at double digits, 10, 11% growth in spending, we do think it'll be mid-single digits. There's still a healthy balance sheet at the consumer level. Jobs are going to be increasing over the balance of this year. So while growth is moderating, consumer spending is moderating, it's still at a healthy level, which just means you're going to see upward pressure on rates from here rather than retesting the lows. We think we may end the year on a 10-year at around 1.8% would be our target.
180.
Number.
OK, I heard 2 things there. In fact, 3. I heard 180. I also heard politicians and spending. Can we talk about that too? There was a letter from moderate Democrats to the Speaker of the House, Nancy Pelosi, pushing back against spending even more before we've agreed to spending the $550 billion, the bipartisan infrastructure bill. And now there's a real conversation, Victoria, that maybe this whole thing falls apart down in Washington. Now, from your perspective, is the bar sufficiently low enough in the bond market now that we are going to respond a lot more to upside surprises in D.C. than perhaps downside surprises on spending?
Yeah, I mean, spending is always a big issue, and we've just had all of these stimulus packages over the last 18 months or so that really have driven some of the yields in the bond market. When we look at these pressures right now, I do think there's going to be a little bit more surprise to the upside. If we get the $500 billion that they're getting ready to vote on, then we've got another, $3.5 trillion coming behind that. I don't think most people expect for all of that to get pushed through. If it does, then perhaps we do see more issuance that flows through into the yields, and yields start to push a little bit higher. But I mean, let's look at the auctions that we had this past year. The 10-year was an incredible auction.
Stella.
So we see there's still demand out there for these treasuries.
Brilliant demand this week on a 10-year. We'll run through those results a little bit later in the programme. Gene, I want your view on this. And I'll just read out Bank of America's take on things at the moment. As far as the spending decisions are concerned down in D.C., they say the following. Views and positioning suggest risk of a further rally, but with expectations for infrastructure spending relatively modest, a surprise there has the potential to drive rates higher. Gene, do you agree?
I think it is possible on the margin. I think this is much more the long game than the short-term game. Treasury supply is very difficult to map to movements in Treasury yields in real time. In fact, if we think about last year, supply was increasing due to all of the spending for the pandemic, but demand was exceptionally high for Treasuries. I think if deficits are going to be significantly larger to fund long-term investments in large-scale infrastructure, that should have the impact over a long period of time of raising the real neutral interest rate. But I wouldn't put a big short position on in the Treasury market today based on these deliberations from Washington we're hearing right now.
Gene Tannuzzo, Victoria Fernandez and Tony Rodriguez sticking with us. Up next on the programme, the auction block, a debt deluge pushing high yield to its second busiest August on record as the rush to secure funding continues. That conversation up next. From New York, this is Bloomberg. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield, and it's time now for the auction block, where we kick things off right here in the United States with strong demand for 10-year paper. The Treasury's auction stopping more than 3 basis points below expectations, with indirect bidders climbing to a record high. High-grade companies starting the week on a major debt binge. Intel leading the charge with 30 borrowers issuing $36 billion in just 2 days, and high-yield issuers posting another week of heavy sales as borrowers rush to secure funding. Royal Caribbean tapping debt markets for a third time, helping drive sales above $10 billion for the week. Still with us, Tony Rodriguez, Victoria Fernandez, and Gene Tannuzzo. Tony, I want to come to you. In the credit market right now, you say we're priced for reality, not priced for perfection. And I hear a lot that we're priced for perfection. So why the difference with you?
So the difference is that when you look at the fundamentals, we really have outstanding fundamentals. We saw a second quarter earnings story that was an absolute blowout in earnings. When you look then to upgrades, downgrades, we're seeing significantly greater upgrades and downgrades in the credit markets. And then when you look at defaults, we're actually seeing forecasts for year-end trailing 12-month default rates of below 1% in the high yield market, and 2022 forecasts of 1.25% to 1.5%. So the fundamentals are telling you that corporate credit health is very strong, cash flow, margins are high, et cetera. So valuations are certainly full. We don't expect to see much opportunity for spread tightening from here, but we think that the yield you are earning is very well supported by strong credit fundamentals. Therefore, priced for reality rather than priced for perfection.
I guess that all comes down to the eye of the beholder. So, Victoria Fernandez, your view on that, price for reality or price for perfection?
No, I like the way Tony addresses that, saying price for reality, because I do think that credit fundamentals are pretty strong. We have had spreads remain really tight year to date, both investment grade and high yield. It's just in the last couple weeks that we've seen high yield really start to move a little bit wider, and that gap between high yield and investment grade grow. So that is a warning sign. That is something we want to watch and see what happens with the spread between those two. We would start bringing our quality back to that higher quality levels just because of that gap. But we do think the fundamentals are there, strong balance sheets for these corporations.
Gina, we're starting to see a little bit more discrimination in the credit market.
A little bit, but let's be honest, credit markets are expensive, and they're expensive for a reason. I think Tony and Victoria described it well. Fundamentals are strong, but we need to recognize that we're in a unique, unsustainable growth environment. We've added near 1 million jobs for a couple months in a row. That's not a normal run rate for a large economy like ours. It is one that still says there's pent-up demand, and we are still getting people back into the labor force. So there are a lot of growth dynamics right now that are temporary, but yes, fundamentals are strong and credit spreads reflect that. What we need to be very careful of is how companies are using their cash right now. We have seen an uptick in dividends and share buybacks, and lower quality issuance in the high yield market started to increase at the beginning of this year. Now, it improved a bit in the second quarter, but we need to be pretty diligent here because spreads are coming from a level that doesn't really provide a lot of extra cushion for uncertainty.
Well, let's explore what would happen when the Fed starts to pull back. We've had a ton of Fed speak through the week so far. This was from Boston Fed President Eric Rosengren speaking to the Associated Press and saying this about pulling back on QE. If you continue to purchase assets, the reaction primarily is in pricing, not so much employment. I don't think asset purchases are having the desired impact on really promoting employment. There's a Fed official, Tony, questioning the value of QE, the value of it, and basically suggesting what we've all been talking about for the last 10 years or so, what it actually does. What happens when that gets pulled back? Because they have lined up one by one to signal that in some way, shape or form this week.
Jonathan, you make a great point. I think most of the Fed would tell you that they don't think that the QE is supporting the labor markets directly. It's clearly just trying to impact overall financial conditions. And I think the story is that the QE that was instituted a year ago was quite necessary to support financial conditions in the broader economy. But today, it's surely not necessary. The issue is that the Fed doesn't want to just wake up and overnight begin a taper. So they have a communication issue. And this is all, I think, part and parcel of trying to communicate to the markets so that when they begin the taper, which we think will be announced in the November or December meeting and begin in early January, that the market is not surprised by it and that it doesn't have a significant impact. Our view is that it will not have a significant impact and certainly is not going to affect the labor market because it hasn't helped it either. Now, financial conditions will remain, we think, healthy because there's been a transition from a weak economy to a reopening economy to a strong consumer to what we think is a stable growth picture in 2022.
And they're very keen to say this is not about tightening. Even the people who you'd say were less dovish than the super doves, even they want to aggressively de-link any move on tapering from tightening or any signal from higher interest rates. Here's a question for you, though, Gene. You mentioned on the pockets of tension within credit. I've asked this question all week. Can we expect credit to be the canary in the coal mine anymore when the Fed has given credit a gas mask?
I think it actually has to be because of that, right? So Tony mentioned the critical term, which is financial conditions. That's exactly what quantitative easing affects, right? It affects financial conditions. Financial conditions are about three things, right? They're about asset prices, they're about access to capital, they're about animal spirits. Those three things are all very strong right now. And as those asset purchases start to change, it will influence financial conditions. And right in the heart of that, the variable that is most closely correlated to financial conditions are credit spreads. So I actually think by virtue of the Fed moving towards the exit, if they don't influence credit spreads, I actually think they're not making any change at all to their policy. So they're almost saying they have to influence credit spreads in order for their policy to change.
Victoria, final word.
Yeah, I mean, look, I think you can always look at credit spreads and it give you an idea of what's going on in the market or what the anticipation is that we're going to see. I don't think tapering is going to have a huge effect either way. There is so much liquidity in this market right now. Companies are flush with it. Individuals are flush with it. So I don't think it's going to make a huge movement, but I do think you still watch spreads because that's going to be your first clue to when we do need to have a warning in regards to the economy moving forward.
Victoria Fernandez alongside Gene Tannuzzo and Tony Rodriguez sticking with us. Still ahead, the final spread, the week ahead, featuring Fed minutes and a speech from the chairman, Jay Powell. That conversation up next. This is Bloomberg. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. The week ahead, coming up, Fed Chair Jay Powell set to speak at a town hall event on Tuesday. Plus, we get US retail sales for the month of July, FOMC minutes out on Wednesday, a 20-year Treasury auction, and more Fed speak from Dallas Fed President Robert Kaplan. With us for some final thoughts, Tony Rodriguez, Victoria Fernandez, G. Tannuzzo. Victoria, to you first. What are you looking for from the chairman next week? And that's the town hall before we get the speech at Jackson Hole in the following week.
I'm not looking for a lot from him, Jonathan. I mean, I think he's going to stick to the story that he has laid out for months now, that he thinks inflation continues to be transitory, or at least the majority of it. They are possibly, he might say, they are on track for substantial progress. That may come out at the Jackson Hole meeting. I don't think it'll be this next week, but I really think we're going to be kind of status quo until we get to that September meeting. And that's going to be an interesting one, because we're going to have the jobs report before that, which I think is going to be maybe a downside surprise for most people.
So Victoria says we can skip the town hall next week. Let's talk about whether we can skip Jackson Hole. This is a rapid fire round. 3 quick questions, 3 quick answers if we can. Jackson Hole, do you take a vacation or do you stay at the desk and watch this one play out? First to Eugene.
I'd say get your popcorn. I think we need to learn more about substantial further progress in the labor market.
Victoria?
Take a vacation.
Tony?
I think you can take a vacation.
2 out of 3. I'm taking a vacation, just for the record. Second question. September taper announcement, November or December or beyond? When do we get it? September, November, December or beyond? Victoria?
November's the announcement.
Tony?
November.
Gene?
September's not off the table given what the Fed's been saying, but November would be our base case.
Final question, 10-year Treasury yield. Have we seen the lows for the year or the highs for the year on a 10-year yield? The lows or the highs? Tony?
We've seen the lows.
Gene?
Both.
Both. Victoria?
We've seen the lows.
There we go. Guys, thank you. Great to catch up with all three of you going into the weekend. Tony Rodriguez there, Victoria Fernandez and G. Tannuzzo. From New York City, that does it for us. We'll see you next week. Same time, same place. From New York City, this was Bloomberg Real Yield. Enjoy your weekend. This is Bloomberg TV.